The richest people in the world are sitting on hundreds of billions of dollars in plain cash, not stocks, not real estate. Cash sitting in an account. And at the very same time, they are telling you through every book, every course, every advisor in a nice suit to put every single dollar you have into the market. Today I'm breaking down exactly why that advice exists, who it actually protects, and the real reason the wealthiest people on the planet refuse to follow their own rule. By the end of this video, you'll know the exact amount of cash almost nobody in this industry wants you to hold. Because even if you've never invested a cent in your life, this affects you. This isn't about being rich. It's about who gets to make the rules and who's stuck following them. Let's start with the number that should bother you. Warren Buffett, arguably the most successful investor alive, was sitting on over $300 billion in cash through Berkshire Hathaway. Not because he lost faith in the stock market. Because he was waiting for prices to fall low enough that cash became more valuable than any stock on the table. Hedge funds do the same thing. Family offices that manage money for the ultra-wealthy typically keep somewhere between 10 and 20% of their entire portfolio in cash or cash equivalents at all times. That's not fear. That's strategy. Meanwhile, the average person gets a completely different message. Financial influencers, robo-advisors, even well-meaning finance books tell you that holding cash is lazy money, that it's losing value to inflation every single day it sits there, that the only smart move is to be fully invested, 100% of the time, no exceptions. So ask yourself, if being almost entirely in cash is a smart, disciplined move for the richest investors on Earth, why is it framed as a mistake for you? Here's where it gets personal. Picture two people. Person A followed the advice. Every spare dollar went into index funds the moment it hit their account. No cash sitting around doing nothing. Person B kept a cash cushion on the side, even though everyone told them they were leaving money on the table. Then the market drops 30% in a matter of weeks. Person A gets a call from a leaking roof, or a car that dies, or a medical bill that can't wait. They have no cash. So they're forced to sell investments at the worst possible moment, locking in a real loss just to cover a real-life emergency. Person B pays the bill from their cash reserve without touching a single share. And a few months later, when prices are still depressed, Person B has money sitting ready to buy shares at a discount, while Person A is still trying to recover from the loss they were forced to take. Same market, same crash. Two completely different outcomes, not because one person was smarter about picking stocks. Because one of them had cash and the other didn't. And this isn't a hypothetical. In 2008, while millions of regular investors were forced to sell their retirement accounts at the bottom just to stay afloat, the investors and firms holding cash bought entire portfolios of real estate and stocks for pennies on the dollar. Warren Buffett alone deployed billions into companies like Goldman Sachs and General Electric during that crash, on terms that guaranteed him massive returns, simply because he had the cash available when almost nobody else did. The same thing happened in March of 2020. Markets collapsed in weeks, and the people who had cash sitting on the sidelines bought some of the best entry points of the decade, while everyone who was fully invested with no buffer either rode the crash down in fear or sold at the exact wrong moment. It's the same story every single time. The crash doesn't create the wealth gap. The cash does. This is the part almost nobody explains to you, and it comes down to incentives. Most financial advice you consume, whether it's a certified advisor, an app, or a finance channel, is built around a simple business model. The more money you have actively invested, the more fees get collected. Assets under management fees are calculated on the total amount invested, not on what's sitting safely in cash. Cash sitting in your account earns the advisor nothing. Cash invested in a managed fund earns them a percentage every single year, whether the market goes up or down. So it's not a conspiracy in the dramatic sense. It's just math. The industry that hands out the always be invested advice is the same industry that profits when you follow it. Now let's get into the actual reasons the wealthy keep cash, because none of them are about fear of the market. The first is optionality. Cash means the ability to move instantly when an opportunity shows up, whether that's buying stocks during a crash, buying a property from a seller who needs to close fast, or investing in a business before anyone else gets the chance. The second is protection against forced selling. Wealthy investors structure their finances so they are never required to sell an asset at a bad time to cover a bill. That single habit alone is responsible for a huge amount of the wealth gap between people who compound their money for decades and people who get wiped out during downturns. The third is negotiating leverage. Cash buyers get better deals, whether it's real estate, a car, or equity in a private company, because sellers value certainty and speed over a slightly higher offer that depends on financing. The fourth is psychological staying power. Investors with a cash buffer don't panic sell during a crash because their day-to-day life isn't threatened by market volatility. Panic selling during downturns is one of the biggest wealth destroyers for regular investors, and it's almost always caused by not having cash set aside for real life. The fifth reason is tax and timing flexibility. Cash lets wealthy investors choose exactly when to realize gains, when to harvest losses, and when to deploy capital, instead of being forced into decisions by circumstance. And the sixth reason is the one that gets twisted the most: inflation. You've been told that cash constantly loses value, so holding it is always a mistake. But that only tells half the story. If your cash allows you to buy a stock at half price during a crash instead of buying it at full price today, the inflation you lost while waiting is nothing compared to the discount you just captured. The wealthy aren't ignoring inflation. They're using cash as a weapon against it, not a hiding spot from it. It's not just individuals either. Look at corporations. Apple alone has held over $100 billion in cash and short-term investments at various points, not because its executives don't understand investing, but because that cash lets the company acquire competitors, buy back its own shares when the price drops, and survive any downturn without borrowing on someone else's terms. The exact same logic that works for a trillion-dollar company works for a household budget. The scale is different. The principle is identical. So what does this actually mean for you? Not dump your investments and hoard cash. That's the opposite mistake. The real lesson is that cash and investing aren't rivals. They're two different tools with two different jobs. Your investments are supposed to grow your wealth over decades. Your cash reserve is supposed to protect that growth from ever being interrupted. Most personal finance advice skips this because just invest everything is a simpler headline than build a buffer first. Then invest with real conviction. A common benchmark used by financial planners is 3 to 6 months of essential expenses kept in cash before aggressively investing beyond that. Some people, especially those with less stable income or bigger financial responsibilities, keep more. But the wealthy actually think about cash in two separate buckets, not one. The first bucket is the emergency fund, pure protection, meant to cover job loss, medical bills, or anything life throws at you, so you're never forced to sell an investment at a loss. The second bucket is the opportunity fund, cash kept specifically to deploy when the market drops or when a rare deal appears. The same fund Buffett was sitting on before 2008. Most people are only ever taught about the first bucket, if they're taught about cash at all. Almost nobody outside of wealthy circles is taught about the second one, because the second bucket is the one that actually builds generational wealth. The exact number for either bucket isn't the point. The point is that the number should be a decision you make on purpose, not a rule the industry handed you while quietly doing the opposite themselves. The system didn't lie to you by accident. It told you to be fully invested because a fully invested population is a profitable population for everyone except the investor forced to sell at the worst possible time. The people at the top didn't get there by ignoring cash. They got there by understanding exactly when cash is more powerful than any stock chart. If this changed how you think about your own safety net, the next video breaks down the exact net worth milestones the wealthy hit at every age, and why the number you've been told to aim for is almost always wrong. Subscribe if you want to keep seeing how the financial system actually works, instead of how it's marketed to you.